welcome to the Maple-Brown Abbott 2026 Outlook Series. My name is Dean McLelland, and with me today I have Andrew Maple-Brown, co-founder and managing director of Maple-Brown Abbott Global Listed Infrastructure. Welcome, Andrew.
Thank you, Dean.
Can you give us your 2026 outlook for the asset class?
We're pretty optimistic about the outlook for the asset class. Firstly, we're really excited about the growth we're seeing in the sector, which has really been driven by the mega themes of digitalisation and decarbonisation. From a macro perspective, we think the sector's pretty well positioned. We think there's risks around growth. At the same time, inflation's remaining sticky, and those conditions are very supportive for infrastructure assets. And thirdly, from a valuation perspective, we think that the assets are fairly valued relative to where these companies have traded historically. We think they're very cheap relative to where comparative assets trade in the private markets, and also relative to where global equities are trading more broadly.
And given that outlook, can you take us through how the Global Listed Infrastructure Fund is positioned to take advantage of that backdrop?
So about 40% of the fund are currently invested in electric utilities, or utilities which are predominantly electric. We think there's a big opportunity for further investment in electric utilities, which is being driven firstly by the energy transition, but also more recently by the increasing demand growth, particularly driven by data centres. That's going to drive earnings per share growth. In the US regulated utilities, for example, traditionally these utilities have grown by about 4 to 6% per annum, whereas a lot of our utilities are currently growing over the next 5 years at 6 to 8% per annum, or sometimes stronger. We've positioned the portfolio over the last 18 months or so, particularly focused on the electric utilities, which are the biggest beneficiaries of the data centres. But some of those valuations have performed very well, or stock prices have performed very well. And so we have started to shift into the utilities which have less of that exposure, where valuation opportunities are better. About 12% of the portfolio are currently invested in water utilities. We really like water utilities. We similarly see a very large investment need. But water utilities are attractive because these projects, there's many projects, so small value projects, so less project risk involved in a water utility. There's also less bill pressure, less affordability concerns, and that leads to lower regulatory risk. And finally, we also see less stranded asset risk because there's less substitution involved in a water utility. We particularly like the UK regulated utilities, which have recently gone through their regulatory reset, and so have several years remaining of regulatory predictability. About 15% of our portfolio are currently invested in telecommunication towers. So towers at the moment are particularly cheap relative to historical levels, but at the same time we're seeing continued growth in data usage. The towers we think are a critical part of that universe in terms of the provision of that data. They have very high barriers to entry, and so we like them as infrastructure assets and see those valuations as being attractive. We invest in towers in both Europe and the US. In terms of elsewhere in the portfolio, about 20% of the portfolio are invested in transportation assets, predominantly toll roads, but also airports and railway track. And the final 10% of the portfolio are invested in assets subject to long-term contracts, especially renewable assets, pipeline storage assets.
Thanks for your insights today, Andrew. Appreciate it. I wish you and the team all the best for the year ahead.
Thank you.
If you'd like to hear more about the Maple-Brown Abbott Global Listed Infrastructure Fund, please visit our website.